Leading the group lower, it was the worst performing sector in the S&P this session and has been the biggest drag on the market this quarter. One of institutional investors' top oil analysts warning there's no relief in sight. Paul Sankey is president and lead analyst at Sankey Research. He joins us here on set. Paul, always great to see you in person.
Hi.
What do you think this means in terms of how low oil prices can go?
I think we're looking for the point at which you balance the market through price, and that means that you're going to have to shut down probably U.S. unconventional production. On our numbers at the liquids, overall liquids level, the U.S. production is around 20 million barrels a day. We think that's got to drop by about 2 million barrels a day to balance the market, assuming that OPEC follows through with these increases that they've been talking about. So it looks like a very bad balance.
So you're talking about oil prices have to go lower in order to shut production down, which will then buoy oil prices.
Yeah, so we just had an interesting press release from Diamondback, which is, top Permian operator, and what they were saying is they won't resume any kind of growth until we get past $55 a barrel. Would really be more like $65 a barrel would be the level at which they would restart growth. And now they've just announced they're cutting capex by 10%. This is one of the best operators and $400 million, so not an insignificant amount of money. So what you're looking at here is already the best-in-class guys ahead of this downturn, because we haven't seen the demand downturn actually hit yet. But ahead of it, they're getting themselves ready for what is a market share war, and that would imply $40.
40.
40s oil would be where you're headed if you're really going to shut down the U.S. Yeah.
Wow.
Well, pun intended, but let's drill down a little bit there, because it's be careful what you wish for here in the United States, because at a certain price, it really hamstrings people down in Texas and people up north as well, and this is not good for the industry here in the U.S.
Yeah, and Diamondback's letter tonight makes that point, that the oil and gas industry has done an incredible job in the U.S. over the past 15 years. We've become the world's largest oil and gas producer, which is incredibly powerful for things like the U.S. dollar. And, I just don't think you should be hurting this industry excessively in the way that you will be. We also think that relatively equilibrium or higher oil prices are good for the U.S. economy because of what it does for Texas, because of what it does for primary industrial activity in this country. So we don't see this as necessarily positive. However, I've been on this show many times, and we've talked about the coming market share war, and, it came.
But so who's hurting who? Because what I want to understand here is OPEC Plus for years had shown a level of discipline that really, kept almost this uncanny type of lack of volatility in the oil price. You talk about a war that U.S. producers may or may not want to get involved in. Obviously, my guess is OPEC Plus really is not real happy with the U.S. Non-conventional. So talk about this, because everything I'm reading is that in Midland, or certainly kind of for the entire region, you're talking about break-evens where oil prices now are already below that. And again, these are folks that capex discipline, fiscal discipline. This is what they've been about for the last 6 years.
Yeah, but what's happened over the last 6 years, you really formed OPEC. Well, you did form OPEC Plus, which included Russia as the big addition to OPEC in 2016. And what you've seen, for that post-2016 period, which was bringing us out of a big downturn, it did work well as an organization. But when you came to the big test in 2020, COVID, it actually blew up, and the result of Saudi and OPEC inaction, in fact, with disagreement, was negative, nearly $40 oil prices for a moment. So there's been a bit of a mixed track record, and now what you're seeing is gradually the organization is sort of shredding, and the big one at the core of it is Saudi UAE. And when that began to break down, that's when you almost began to completely lose OPEC. Subsequently, this year's crisis has been caused by Russia and Kazakhstan really not playing the game. And that's interesting because Russia, to a given extent, controls Kazakhstan's output because it controls the pipeline. So there's some sort of major issue here within OPEC Plus that's turning into a market share war. And that's basically what the Saudis are telling the press. You can read it in the press. We're going to have a market share war.
Yeah.
If you do that, you have to take oil to where you shut down U.S. production, and you're probably looking at a four handle.
Paul, help me reconcile the economic message of a four handle on oil with an S&P that's retraced all of its April loss.
The oil market is clearly discounting a major recession at some point. Now, of course, an element here of the downturn in oil is the fact that you've got a supply shock as well. These things always seem to come together. Demand downturn coming. Now, if you listen to the director of the Port of L.A., he said that the impact economically is going to be this week. The tariffs were only an April 2nd announcement. So you're expecting to see a physical downturn as of this week. But for example, Valero on their call last week were just saying that the demand side actually is holding up. And to them, everything real time looks fine. You know, Times Square seems pretty busy. It seems like economic activity is continuing. So we really haven't seen the tariff effect, but we expect to see it this week.